Good evening, everyone. Today we have Ronan, president and co-founder of Iex Exchange, joining us today. Welcome, Ronan.
Hey, thanks, Jack. Good to be on.
Yeah, thanks for joining. Before we delve into the good stuff, for those who are watching this and may not know what Iex is, why did yourself and Brad decide to start this company?
Yeah, I'll give you the short story. Maybe we'll get into some of the longer details. But IEX is a stock exchange, as you said. There in the U.S. there's 16 stock exchanges, and we launched in 2012, and we started the company not as an exchange. We when we were at RBC, Royal Bank of Canada, it's a broker dealer here in the U.S. and I mean I guess it's a global broker dealer. We had developed some software for the institutional investment community. So when I say the buy side, I mean like the institutional, like mutual funds, pensions, hedge funds. When they're trading with brokers, a lot of people don't realize they think that they're the most sophisticated guys, but when they're trying to buy stock or sell stock, they're buying it in large numbers. And my background is in network engineering and telecom, and I got involved in high frequency architecture, and Brad was a trader, and we got together and we tried to solve an issue for the institutional investment community, and we were able to do it through some software we developed at RBC. And what happened, though, and it's still a dirty little secret on Wall Street that exists today, is that a lot of times you would imagine that the institutional investors will trade with a broker because that broker provides them the best execution. It's not necessarily the case, because the way in which institutional buy side firms pay brokers for services rendered, so not just trading, for IPO access, for research, for corporate access, the only way in which they can really pay them, I know it's different in the rest of the world, they've unbundled it, but in the US still in 2022, is you have to trade with them. So you might say, hey, I think broker A gave us $10 million in value over the year. You need to trade $10 million, 1 penny a share, to make up for that. And long story short, towards the end of the year, even though RBC was providing them the best execution, the clients would have to go and route their orders to other brokers. So clients said, you created a great solution, but you created a great solution only when we trade with RBC. Said, if you think bigger, we'll support you. So then we came up with this idea, well, what's the center of the ecosystem in all of this? And what do all the brokers connect to? Is a stock exchange. And the ironic thing, or funny thing, or crazy thing is none of us ever worked at a stock exchange nor a trading venue at all. We had worked at a broker dealer, and we kind of just went off on this mission and said, look, if we can put ourselves at the center of the ecosystem, and the institutional investors are trading with whatever broker they want to or have to pay bills, that type of thing, we can still handle their order for them. And we left our jobs in early 2012 to go do that. And obviously, I remember my dad had forwarded me this article by Malcolm Gladwell, and he said, when you talk to people who start companies, many of them say if they thought it was going to be 25% as hard as it turned out to be, they would have never done it. I can tell you 100% of the time, 100% it was kind of like a crazy wild ride. Still continues to be, but it's something glad we did. Anyway, I'm sure we'll get into it. It took a number of years raising money, but what I'll say is we were the first trading platform ever owned by institutional investors. So like firms like Capital Group, Franklin Templeton, hedge funds like Greenlight, Oppenheimer, all invested in IEX. And our pitch is this: if you're the originator of the order, and the marketplace and the complexities of the marketplace and the speed of the marketplace are disintermediating you, rather than sitting there bitching and moaning, why don't you fight technology, a technological issue, with a technological solution? And that's what we pitched. And maybe we're good sales guys, but we got them on board, and we set off on this mission and launched in 2013 as something called an ATS, Alternative Trading System, which also has the negative name of dark pool. And then we became a full-fledged stock exchange as of September 2016. So we've been full-fledged stock exchange for a little over 5 years now.
Awesome. I love that founding story. That's awesome. And as I understand it, the foundational concept of basically including that speed bump is truly interesting. And I think Michael Lewis popularized, from my perspective at least, the term high frequency trading in the retail vernacular.
Yep.
In particular, how can it be used to front run orders?
Yeah, so it's kind of funny, right? So Michael Lewis, the author, we met him by complete chance, and I'll give you a little bit of the background because I think it'll help. He was writing a story in Vanity Fair. I think it's a magazine that's global, but anyway, it's in the US. It's a pretty big deal, and he was writing it on a programmer that had left Goldman Sachs to join a high frequency trading firm. And when he left Goldman Sachs, he had taken some of his code with him. And because he traveled from New York to Chicago, it became an interstate commerce. So when they reported him as having stolen code, the FBI actually arrested the guy when he came to the airport because it was an interstate commerce theft. It's this whole wonky thing. So, and frankly, in full defense of Goldman, they had never pressed it with the FBI to go this far or anything like that. It just kind of snowballed out of control. Anyway, the guy's name was Sergei Linikov, and he was sent to prison. Well, he was sentenced to prison for 8 years, and he served, like literally, of all the people who get off doing way worse things, he's 1.5 or 1.7 years in prison. Anyway, Michael Lewis heard about this story. He knew the lawyer for Sergei Linikov, and it was around high frequency trading, Goldman Sachs, prison. If that's not a trifecta of interesting terms. And he asked to just talk to people in the market who sort of understood what was going on in the market from a market structure standpoint. And Brad is the CEO of Iex. He's one of our co-founders. There was like 4 of us who founded the firm. Brad and I went to dinner with him, and he didn't really want to talk too much at dinner, which was interesting. He paid for it, which was good. We're a startup. We weren't going to pay in this dinner. But long story short, he came by our office the next day, and he started asking about speed and why is speed important in trading, and what does speed do, and are high frequency traders bad? Are they good? And I kind of, it's a really important distinction, because what we always say is neither. It's not that high frequency, you can't say that high frequency trading is bad. However, and that's why we've designed the speed bump, which I'll tell you about. It's the big key tenet to what Iex as an exchange does, different to any exchange in the world, but certainly in the US, is we slow things down. And what we say is, in the US, again, if I'm oversimplifying anything, stop me, I don't mind. But in the US, when you're a registered broker dealer, whether you're a Goldman Sachs, a JP Morgan, or a high frequency trading firm, a stock exchange has to allow you to trade on their platform. It's called fair access rules. So it's not like you could create a stock exchange and say, high frequency bad, you can't come here. And when we looked at it, we're like, high frequency is not bad. High frequency provides a service, but there are certain strategies that these same firms deploy that at a minimum you can say are useless, or you could say they're bad and they're only good for the person running that strategy. So in effect, what we decided to do is build a venue that it's not counterparty segmentation, meaning we're not stopping anyone in particular from trading here. We're not segmenting them, but it's counter strategy that we're segmenting. So if you're running a strategy like a latency arbitrage strategy, which, Michael Lewis liked to use the word front running, but front running is a very different word, and it's an illegal activity. And I think it muddies the water, because then people go, oh, well, it's illegal to front run.
Yeah.
It is illegal to front run, but it's not illegal to electronically front run, which is called latency arbitrage. So in effect, all we do, and it's comedic because people literally lost their shit over this. All we did is, in a market where everything is down and measured to billionths of a second, everybody who trades on Iex comes to our front door, if you will, and then we delay them 350 microseconds. That's 350 millionths of a second. 1/1000 the blink of an eye. I don't know who measured that shit, but that's what they say it is. 1/1000 the blink of an eye. And all we do is we slow them down coming into our matching engine, 350 microseconds. If you come in the front door 1 microsecond ahead of the next guy, you get to our matching engine, which is our technology that matches buyers and sellers, a microsecond ahead of the next guy. All we've done is slow down your arrival there. The key to this, and a lot of people have forgotten this, like 10 years later into Iex, what's the point of slowing down and what does it solve? The real point is this, and it's pretty simplistic, is as a trading platform in the US, whether you're a dark pool ATS or whether you're an exchange, you're obligated to print a trade between the NBBO, which stands for National Best Bid and Offer. All that means is you have to look out, you have to take in all the feeds from all the other exchanges. The exchanges contribute to the NBBO, and you have to find the highest bid, meaning the highest someone's willing to buy, the lowest offer, the lowest someone's willing to sell. So you might go in the market and say the highest bid is $10 on NASDAQ, the lowest offer is $10.02 on NYSE, the NBBO, national best bid, is 10 by 10.02, right? And you're obligated to understand that trade. And what that means is you can only trade between $10 and $10.02. If you trade outside of that, if you printed a trade at $9.99 or $10 at 3, that's called trading true. And you as an exchange can be fined for that. Like it's a violation. But what's amazing, and then this, and sorry to give it such a long-winded entryway, but this will make sense in a second. You have to take in all these circuits to understand the pricing from all these exchanges. And there's 16 exchanges, like I said, in America, names like Chicago, Boston, Philadelphia, New York. All 16 of them are in the state of New Jersey and in 4 buildings in New Jersey. So you have to connect to all these 4 buildings. And what can happen is this, and this is just, it's undebatable. It's factually true, and no one says that this isn't, which is why I take the word front running out of it, is latency arbitrage. What happens is this, is if you're the fastest high frequency firm and you see that the price is no longer 10 by 10.02, the price is now 9.99 by 10.01. The price has come down. If you know that faster and you can race to the stock exchange, Iex, and not only do you know it, you know that information quicker than Iex does. Iex still thinks the market is 10 by 10.02. No market center can be faster than the fastest constituents, the high frequency firms. So what we said is, we'll never compete, no one can compete, but if we put everybody 350 microseconds away, we in fact give our exchange a 350 microsecond head start. That might be a better way to look at it. And what that means is this, market goes from 10 by 10.02 to 9.99 by 10.01. We will always know that because someone has to come, go through our speed bump, and before they get to our exchange, we're like, oh, the market is now 9.99 by 10.01. Why is that important? It's not like Iex trades money. It's important for our clients on the exchange. Would you like to buy stock at $10 when fractions of a millisecond, like thousandths of a second later, you could have bought it at 9.99? Of course you wouldn't. So on Iex, we're the only exchange that can say we are the fastest constituent on our venue because we will always have the best representation of what the best price to trade is. No other exchange, no other ATS can claim that because they just can't, because they're in competition with the fastest of the fastest. So ironically, in a world of speed, slowing things down is what's yielded great results.
Oh, that's interesting. I've always had it backwards in my head for some reason that it would be the other way around. But the solution that you both came up with is surprisingly simple and kind of beautiful in concept. So you mentioned other exchanges. Have the other exchanges, such as NYSE, NASDAQ, or internationally, actually expressed interest or implemented something similar themselves?
No. So I'll say in the US, the answer is no. So if you think about it and you look at NYSE and NASDAQ and CBOE and frankly all the other exchanges, they run a very different model. Again, where, I mean, it used to be more publicly disclosed because they're public companies, but it's harder to extrapolate from their earnings now. But a huge percent of their revenue comes from selling technology to the firms to come and co-locate, to put their strategies in the building right next to the exchange. So the exchange is making more money in this day and age selling technology to its members rather than the money the members pay them to trade there. So it's kind of crazy, right? Like you go back 20 years, maybe 25 years, the single revenue was trading, and also on NYSE and NASDAQ, because they're listed exchange, they would charge listing fees. But other than that, it was trading. Now it's all around technology. And if you want faster connectivity to my venue, you want more private connectivity to my venue, it costs more and more and more money. And while as an exchange, if you offer something to someone, you have to offer it to everybody else. The problem exists there is that these fees are so exorbitant. While technically, if you had the money to pay for it, you could get the same speed as someone else. But a lot of people don't have that type of money. The speed thing that we did, by the way, is very simple. It's very simple. So when you guys hear people talk about latency, I always kind of explain it this way because it's kind of confusing. The biggest component to latency is something called propagation delay. And that's just a fancy way of saying the further away from the signal you are, the longer it takes you to get the signal, which means you're slower. So if you're in New York, for example, all these data centers, like I said, are in New Jersey. Well, you're further away than someone who's in New Jersey. You're closer than someone who's in California. But the closest you can be is right in the same building next to the exchange itself. And the competition to be in those buildings and in close proximity to the exchange, which is measured now in single-digit nanoseconds, billions of a second, you just wouldn't believe the pissing matches that goes into this game as to how fast people need to connect. So when people listen to this, they might be like, this guy's out of his mind talking about delaying something 350 millionths of a second. Our whole point was this: 350 millionths of a second, 1/1000 the blink of an eye. You wouldn't notice it. Institutional brokers don't notice it when they run their algorithms. Investors don't notice it. The only thing that it harms are low latency arb strategies. So to answer your question, if an exchange other than Iex was to slow down the access to their building, to slow down the access to their exchange, to not sell all these feeds and cross connects and cables, they would negate the value of all of that data that they're selling and the high speed. So it runs totally counterintuitive to their business model. There's venues in Canada. Obviously, Canada, no offense to Canada, it's just a much smaller market, but they did like randomized speed bumps and some other stuff like that. But the predominant model globally, I'm not aware of anybody doing it in any other country. It's very simple to do, by the way. Like I was telling you at the beginning, the biggest component to delay is just distance. That's all we did to build the 350 microseconds. We literally coiled fiber optic cable in a box. Now I didn't do it, but I had a firm coil fiber optic cable, 38.1 miles. I think that's 61.2 kilometers. I did that for the Australian crowd and the Irish crowd listening in. I'm that versatile. I give miles and kilometers. But in any case, all we did is we added distance in a box because there's no subjectivity to it. It's not like a software solution that could fluctuate. Everybody's treated the same way. Everybody comes into Iex, the same speed, the same order types, the same pricing. And it doesn't matter what you pay, Ronan, I promise you, no one gets a bypass of the speed bump.
Yeah. And staying on the theme of competitors, looking at SEC market structure data and just you mentioning it then, you see 16 different exchanges listed as having trade volume. And what actually drives that diversity of exchanges on the US market?
By driving diversity, your question is probably like, why the hell are there 16 stock exchanges, right? So if you look at the 16 stock exchanges, till September of 2020, prior to that, there was 13 exchanges. And really, they would call it families of exchanges. There was Iex with one exchange. New York Stock Exchange owns 5 of those exchanges. CBOE, the Chicago Board of Options Exchange, owns 4 of those. And NASDAQ owns 3. So 12 of the 13 were owned by these 3 big families. And let me address that first. What happens is this, as an exchange, you have a protected quote, which means any quote that you put out, like I was talking about the NBBO before, that means people have to buy your data. So the more exchanges you have, the more market data that you can sell, the more cross connects you can sell, the more membership fees you can charge. It like almost has nothing to do with the volume that you trade there. They barely make any money on the trading because what every exchange, what Iex does is it charges you a fee and rebates the other side of the trade. So and we can get into that in a bit because I could explain maker taker. But in any case, that's one of the reasons why so many exchanges can survive. And there's been 3 other new exchanges. Long-term stock exchange, whose business model is more around listings. So I don't say this to denigrate them at all. They barely trade at all, but that's by design. But technically, they had to be an exchange to offer this solution. So the real 2 other exchanges that came out, one is called Members Exchange, MEMEX, and that was built by a bunch of brokers, a broker consortium, because they're getting pissed at the exchanges having such a oligopoly over charging for these market data fees, and nobody has a choice. Iex have to take the feeds and basically have to pay what NYSE and NASDAQ charges, because I can't ignore their quotes when we're trading on behalf of a client. And then there's one other exchange, Iex. It's the Miami exchange. They actually run 4 options exchanges and got into the equities trading business. Long story short is there's also about 30 dark pool ATSs. So there's a lot of fragmentation of volume in the US. Roughly, if I look at it today, roughly 57% trades on exchange, and about 43%, which is called off exchange, dark pools and other platforms. That got as high as 50-50. It actually, over COVID, like about a year ago, December of 2020 and the early months of 2021, there were on some days, for the first time ever, less than 50% of the volume was trading on stock exchanges. The rest was trading off. So there's a lot of fragmentation. I think that's a problem with the market, because fragmentation, complexity, locations of the data centers, all makes for complexities that the fastest of the fastest and the sophisticated people can take advantage of. It's got nothing to do, absolutely nothing to do, with fundamental evaluation of a company and why you buy and sell a stock. That doesn't even come into play.
And do you find that there's patterns you'll find in terms of the type of trading happening on these different exchanges? Or is it much for muchness? Is it just the business model?
Sorry, did you say do we file patents?
No, do you find different types of trading patterns?
Oh, pattern. Sorry. Yeah.
No, we're good.
Yeah. No worries. No, so it's hard to say. So what I can say is this: is I obviously would have no idea, nor would anybody have an idea, much like they wouldn't know on Iex, what broker is trading there, what percentage of the volume on a particular venue is a broker. But a couple of things you can look at is, so Iex, registered stock exchange, we still do about 65 to 70% of our volume is dark volume. We also do a large percentage of the volume that we do is midpoint volume. Midpoint volume, people might know it, but I'll just say the bid is 10, the offer is 1001, 1002. The midpoint is 1001. It's the middle between the bid and the offer. That's usually quite indicative that there's institutional order flow there, right? Because if you're a big institutional firm and you want to buy 10 million shares of Apple, as an example, you can't just go into the market and buy 10 million at once. So you might buy 1,000, 10,000, 5,000 here. And what you want to do is accumulate as much as you can, because you want to, get the upside for your client without impacting the market. You don't want someone to sniff out that there's a big buyer in the market. If you meet at the midpoint, it's the safest place to trade, because if you're a buyer and all of a sudden you're buying on the offer, meaning you're crossing the spread and you're buying the offer, then everybody knows. You see offer prints, meaning if you saw an example of the market that's 10 by 1002 and you kept seeing it trade at 1002, you know there's a buyer there willing to cross the spread, and there's likely a bigger buyer than sellers in the market. But if you trade at the midpoint, you basically both share in the spread, and you don't know if there's a bigger seller or a bigger buyer. To answer your question, that's a form of a pattern where you see there's more midpoint, less displayed liquidity on an exchange. You can say it's a more institutional venue. Like I've had brokers say to Iex, they look at Iex's market share on any given day as an indication to more institutional interest in the market, right? Yeah, we used to. So that's not to say you can get exact patterns or that every exchange is bad. I'm not suggesting that, but that's some ways in which you can look at it.
Yeah, that's interesting. So you mentioned market segmentation before, and market segmentation has been kind of a growing area of interest and concern in the last year, at least in our world. There are lots of places to send an order for execution between public exchanges, off exchange, wholesalers, market makers, ATSs, aka dark pools. And as I understand it, Iex was registered as an ATS, as you mentioned before, and before it received exchange approval. So I wonder if you can explain your origins as an ATS, talk about some differences in trading venues, etc.
I'm going to give you the God's honest truth, and I don't know if this has necessarily been said publicly before, but our goal was this: to launch a stock exchange.
Yeah.
We left our jobs, we put our money into this company, and it was harder to raise money from the institutional buy side than you would believe, because these firms would trade, some of them maybe billions of dollars notionally on any given day, but that's because their mandate is to do that. They didn't have mandates to invest $1 million even into a private company. So it was much more complicated than you would think, even though they're like, this is the solution that we need. So what happened is it took us a while to raise the money, and we decided while we were doing it, because to launch a trading venue, you not only have to, it's not like you can start Facebook, basically started with like 2 servers in a closet at college, right? Yeah. When even as an ATS dark pool, you're regulated. You have to have like a certain number of equipment. You have to have dedicated equipment. You couldn't do anything in the cloud back in 2013. So long story short, we scrapped the idea to become an exchange and decided to become an ATS, and I'll explain what that is in a second. But in effect, it's a baby exchange. And our goal was to do that and make enough money to fund becoming a stock exchange ourselves without having to raise another tens of millions to do it. And thank God we were blessed and we were able to do it. But the real reason, to be completely honest, was the business plan wasn't to be an ATS and then be a stock exchange, but that was the way in which we went about it. So there was a regulation in the 90s, I think it was 1996, but don't shoot me if I'm off by a year or two, but it was called Reg ATS, and it just stands for Alternative Trading System. And it basically allowed, because before then, all you had was the New York Stock Exchange for years, then NASDAQ came along in the 70s, but there really wasn't a lot of competition for trading platforms. So ATS is basically like exchange light. And you know, the secret is this, is on an ATS, you can trade both displayed and dark. And displayed just means that bids and offers, people can see them. Dark just means you can't see them. So what happened though at ATS is, because those displayed quotes are not protected, which just means, like I was telling you before, protected means I can't ignore NASDAQ's quotes or NYSE's quotes. They're exchange. I have to consume them to make sure that I'm trading at the right price. Yep. And ATS, you can ignore it. So what happened is ATSs predominantly became places where people would only put dark orders. And brokers at the beginning just used them. They said, look, if I have the buyer and the seller, why do I have to send both orders to the exchange, pay the exchanges this money to match the orders? Why don't I try and match it myself? So the impetus behind dark pools in the early 2000s was really to try and internalize more order flow to the benefit of the clients, trade in larger blocks, because institutional clients like larger blocks, and have less impact. And then all hell broke loose. And everybody had their own ATSs, and then they stopped even being called ATSs. They started calling them dark pools. And, you know, I don't know who the marketing genius was who first called them a dark pool, but a dark pool is a pretty shitty term for a trading platform, because how can you not look at it and think, like, I wouldn't want to put anything in a dark pool. I don't even know what the hell it is. Like, come here and put your money in a dark pool. No, fuck off. That's crazy, right?
Yeah.
But that's kind of what happened. And then there was, like, you know, there was shady behavior happening. And it's not just, I'm not IEXing it. You'll see there's been a history of the SEC fining dark pool operators, who are usually brokers. And really the fines come around. You said your dark pool behaved this way, but you're doing this. You're allowing people to come in and look at the orders. You're looking at the orders, all these type of things. So while I'm not anti-dark pool, I would be more pro, more disclosure and regulation around these ATS as dark pools. Because when you become a stock exchange, when we filed to become a stock exchange, you subject yourself to a world of scrutiny, but you do get the protected status, which is important. But you subject yourself to real scrutiny. Like, for example, if you come up with a new order type that you know will help investors, you know it will, fucking, like, guaranteed, you have to file it, go through this whole process of comments and arguments. And it's funny, it ties back to your question earlier, exchanges copying us. When we filed to become a stock exchange, what you need to do in the US is you file with the SEC something called a Form 1. So Form 1 document is your registration, you know, filing, how we're going to operate, what we do, order types, etc. The SEC posted, it's called to the Federal Register, and they look for public comment, right? And it could be my mother. Anybody could come. My mom could go, Ronan's a good boy. Approve this exchange. She did not. She's Irish. I don't think she'd ever refer to me that way. But you could submit comments. The previous 4 stock exchanges before us in this process, between the 4 of them combined, had 3 comment letters. Before Iex got approval, we had 532 comment letters. And the vitriol of dislike for our speed bump from the high frequency trading community and the exchanges, like the New York Stock Exchange, for example, I'll say this because it's all on public record, submitted 3 comment letters attacking us. They said this is like putting a slow lane on the Autobahn. This will cause a calamity. These are their words, so I don't need to edit these out. A calamity. And then, interesting enough, to bring it back to the question you asked earlier, 6 months after we got exchange approval, New York Stock Exchange took one of their 5 exchanges, NYSE American. They put a speed bump on it, funnily enough, 350 microseconds, and they marketed that they are the same as Iex, but 78% cheaper. So they were trying to undercut us on price. It never took off because I think people got the joke. You can't sell speed on a speed bump on the same exchange. And they ran that. I'd have to check the exact numbers, but it was less than a year, maybe 6 to 12 months, and they never did it again. And that's the only attempt. I just thought it was hilarious that the attempt was made by people who so publicly attacked us. I'm not perfect in life, but if I put something in writing, I'll stand behind it. Put it that way.
Yeah. So Gary Gensler has suggested that aspects of the equity market structure are overdue for reform. Now, not everyone wants to see a system that benefits them change. Do you see the regulation national market system actually being reformed in the near future?
So I think obviously Gary Gensler's heart's in the right place, and I think and I mean this is, anyone who knows me know I don't blow smoke up anybody's ass. So I say what I believe and what I feel. I think the SEC over the past 10 years have gotten much more progressive in how they deal with market structure, and sometimes they get a little bit of a bad rep. Gary has come in pretty aggressive aggressive, I mean, in a good way. And he wants to change a lot of things, shake a lot of bushes. He's asking a lot of the right questions. Reg NMS, National Market System, is sort of what people do when they don't want something changed. So someone might say, you should ban rebates. You should get rid of rebate tiers. And people go, no, you know what you should do? You should look at the entire Reg NMS and turn that thing upside down. And it's kind of like, look over here at the birdie in my hand, right? It's, to me, Reg NMS is a big construct of how all of this is stitched together. And to say you should overhaul the whole thing is kind of disingenuous, but it's a good way to mix it up and delay things. Like if you think about it this way, the SEC a few years ago, it was under Jay Clayton, who was also a great commissioner. I'm not saying anything wrong about it, but they proposed something called a TFP, the transaction fee pilot. And there's been a debate, a hot debate, like in the industry since like 2007 on should exchanges be rebating one side of the trade and charging the other side? Does that not, offer perverse incentives where you route your client's order to the venue that pays you the most, right? You can argue this. Well, I happen to believe the answer is yes, it does. But anyway, this is a debate. And the SEC proposed a pilot in 700 names, 700 stock symbols, right? Across a broad swath. They put it out there for comment. There was institutional investors, brokers, Iex, many others supportive of it. This stock exchanges, again, this is all public, so I have no problem saying it. New York Stock Exchange, NASDAQ, and CBOE sued their regulators to ban them from doing a pilot. And when they first did this, I'm like, that is mental. There's no way you can sue your regulator to stop them doing a pilot. Like maybe if they said we're banning rebates, a pilot, and they won. They won the lawsuit because in the eyes of the court, not my eyes, the SEC didn't make a better case as to the harm of this practice. So why should you even have a pilot? Anyway, sorry that I went long-winded, but my point is this: is Gary's heart's in the right place, but it's very, very hard to regulate. And you said it. There's a lot of people who are super, super, super happy with the status quo, and they don't want that changed. And they'll say, the equity markets are the greatest markets in the entire world. I'm like, oh, blah. Yeah, the markets have gotten much more efficient, much better over time. And you don't have to strive for perfection. But if you can fix things along the way and make something that's better, even better, why wouldn't you do that? And so I think what you will see, his desire is genuine. I think you'll see proposals, but the proposals will be more along the lines of maybe not paying rebates in liquid names, maybe looking at pricing tiers, and are they anti-competitive? Maybe looking at payment for order flow on the retail side. There's so many things that a gross overhaul of NMS, there's not a chance in the world that that would happen. And if it happened and it was proposed now, the transaction fee pilot took about 18 months to be sued and stopped. So if you think you're going to change NMS meaningfully over that period of time, I think you have to do it more surgically, and I think that's what will happen or will attempt to happen. So sorry if I went on a tangent there, but that's what I feel.
So what are the top one or two foundational aspects that you would want to see changed?
Yeah, I mean, look, Iex, we've been very public about this. Both the founders when we were at RBC and while at Iex, and I can say it in earnest because we've put our money where our mouth is. We are totally against rebates, meaning enticing people to come to your exchange by rebating one side of the trade. The largest exchanges in the US all pay rebates. For display trading, they have the longest queue sizes, meaning people are lining up in the largest venues, and they have factually, not Iex data, from attack data, trade and quote data, they have the worst execution quality. So why in the name of Christ would you line up in the longest line for the worst outcome? Because people are routing where the rebate is more important to them than actually getting best execution. So Iex from day one, we've never paid a rebate. And I guarantee you, to do pricing changes as an exchange, it's the one thing we can do. We can submit that, and it's approved on filing. We could change our pricing overnight and pay rebates tomorrow, and guaranteed if we did it, our market share would grow, but our market share wouldn't grow the right way. So I'll get off the pulpit, but we have always been staunch supporters of looking at the payment and the perverse incentives of rebates. The other thing that I think I would love to see happen is, in life, usually you buy more, your price per unit goes lower, right? I'm not against volume discounts. But what's happened on the exchanges, they've gotten to such a scientific extent that in order to get the largest rebate, to meet these tiers, you have to send so much volume to a particular exchange. And now brokers, whether they'll admit it publicly, have found themselves a little bit hamstrung, whereby in order to get the best rates for their clients that want those rebates, they cannot afford to not send all the volume to this particular venue, because if they miss that tier, the tier works this way. They do it on a monthly basis, and it goes up until the last day of the month. And if you make your tier on the last day of the month, you get that special rate for the entire month before. So it's right up until the 31st of the month. If you miss that tier, you might be getting a rebate of 25 mils a share. If you make that tier, you might get a rebate of 29 mils a share. And I know this 4/100ths of a penny seems small, but when you're talking about people who are trading billions of shares, it's millions and millions of dollars a month. So I think those type of things, that's where pricing tiers and rebates don't make sense, and it's something we've been very consistent on. It's a hard call. I think the rebate tiers would be easier for the SEC to address, but everything with this complexity is you pull a string and then what happens over here, right? So I recognize there's arguments on both sides, but I say it emphatically because Iex could be much larger, but we've focused, and we say it in here internally, like if you were a fly on the wall at our all hands meetings, it's always about our goals are growing market share, but growing it the right way.
Yeah.
And by the way, we're like 2.7% today, and I mean this in a respectful way. We're very profitable at 2.7%. So it's not like we're all sitting here eating salt soup for the last 10 years going, we will never pay a rebate. So um, there were many years when we were in the red and we still never paid a rebate. So I do believe strongly we're walking the walk.
Awesome. So, changing topic to more recent headlines about Iex. In the last year, people have become familiar with Iex, a product called Delimit,
Yes.
namely because it is subject to the lawsuit involving Citadel, Iex, and the SEC. We understand that you can't talk about the case itself. However, can you touch on Delimit specifically, and can you
Yes.
explain what it is and maybe why it is so novel?
Yeah. So I thanks for that question because I have to tell you, we've done a lot of things both at RBC and IEX that I call inventions. We have. I will tell you this: people that don't even like us will say this. At least you guys innovate. So we are always trying to do different things, and I think delimit is probably the coolest thing that we've come up with. So delimit is an order type, and an order type just means when a broker sends an order to an exchange, they can choose that the order follow certain parameters, right? It's the broker's choice. They don't have to use delimit. What we did is displayed trading in the US, which means on exchange, if you display your bids and offers, you want people displaying bids and offers because that's the best way to get an indication on supply and demand on a stock. But because display trading is so toxic, meaning the performance of people trading displayed has been so bad because it's, I'll use another Wall Street term, but explain it in English shortly thereafter. There's something called adverse selection. And adverse selection means you put your bid out there, I want to buy at $10. You got sold at $10, and less than a millisecond later, you could have bought at $9.99. And that happens all day long, and it's predictable. So what we said is, look, if you want to enter the market and you don't want to be adversely selected, meaning you don't want to trade at 9 when a minuscule moment of time later you can trade at 9.99, we created a model, and our model predicts when the quote is going to move. So we say, hey, Jack, you want to trade here, you use a delimit price. If we predict on your behalf that the quote's going to move to 9.99, we're going to move you out of the way. So if you use a delimit order, our model says the market's ticking down, we can move you out of the way, which you could not do yourself quicker than the fastest high frequency trading firms. Again, the strategy that they're doing is totally legal. I'm not villainizing them, but we don't like that strategy on IEX. So those firms, we welcome them here. They're good people. They trade a lot of good stuff. But again, it's just counter strategy selection. We're like, we don't want our clients to buy at soon to be stale quotes. So we filed to do this, and it's very, very novel because there's in the US, like I was saying, a displayed quote is protected. And there's the sanctity of the protected quote. You're going to allow an exchange to move a quote? To me, I'm like, fucking sure. It's common sense, right?
Yeah.
We have the data that shows how often people are getting plowed and who they're getting plowed by. And they're getting plowed, meaning they're buying at 10, almost always exclusively against the fast players. There's no institutional order coming in across the country and coming into IEX and trading within 2 milliseconds of a quote change ever, unless by complete fluke chance. But there are firms who we would get 70%, 70% of their orders would come in right when our signal says the quote's going to change. And the data shows that we are protecting clients. We are protecting institutional clients. And like retail is really important. And I'm really honored that you asked me to be on this. But the beginnings of IEX was around protecting institutional orders. But the way I look at that, we're not protecting big Wall Street fat cats. In some of the cases we are. But like when a T. Rowe Price comes in to buy $100 million notional of Apple, behind them are millions and millions of institutional investors. And like, most people have way more money in their pensions and their 401ks than they do to trade on the side themselves, from in a retail fashion. So it's important to protect both sides of the pie. And that's something we've really focused on doing for the institutional investor. On the retail investor, which is why, like I said, I'm really honored to be invited on here. The retail investor has made just remarkable strides in the past like 18 months by being vocal about what's going on, right? Because it's like anything, you have to shine a light on something for it to get focused, and enough people are like, complaining or calling something unfair, things get focused. The way that it works in the U.S., and I'm sorry if you don't want me to jump into this right now, but like retail trades rarely ever make their way to stock exchanges. The way that it works today, it's not all, but the vast majority. So I'm generalizing, but the vast majority, the way it works is retail client says buy, sell, whatever they're using, Fidelity, E-Trade, Schwab. Nothing wrong with any of these folks. Don't get me wrong. They send in the order to buy 79 shares.
Mm-hmm.
What happens next is the retail brokers almost exclusively send those orders to wholesalers. And the wholesalers will say they will provide price improvement, it's called. So you don't pay the retail brokers. So I always say, is there any free lunch in this world? It's free to trade with them. They send the order to the wholesaler. They don't pay the wholesaler to trade with them, because imagine if they did and people weren't paying a broker, they'd go out of business. And the wholesaler, who are very big institutions over here, have such a look on the market, a lot of technology, a lot of intelligence, will provide the retail broker back a printed trade. And they will say, we price improve the trade. And price improve goes back again to what I was explaining at the beginning, the national best bid and offer. If you had a 10, let's say you had a seller willing to sell at $12, and they sold any less than $12. So the market is 10 by 12, and they sold at 11 cents, 0.999. Technically, they were price improved because they didn't sell at the offer price. So when you hear price improvement, that's all that means. You buy for slightly less than the bid, you sell for slightly less than the offer.
Yeah. So retail traders have on offer a broad array of brokers, as you kind of just mentioned then, but very few offer directed orders through Iex itself.
Yes.
Putting aside those that only allow non-directed orders for payment of order flow, why are not all exchanges, including Iex, universally available to direct trades to?
Yes. So the answer is this: we are universally available. People don't avail themselves of that universally. That's a good line. I should write that one down. But that is the truth. If you're a registered broker dealer, which these retail brokers are, they could come here. If you think about it, though, in the retail community, again, to generalize, there's a thing: it should be free. I should get fast execution. And in order to do that, if a retail broker was to send an order to buy, like I think I said 79 shares of Apple in my example, to Iex, you could send it to Iex, but if we don't have a seller at that moment in time to sell it, well, then you're not going to match up. And you can do a few things. You can stay on Iex, or people will just do what's called an IOC, immediate or cancel. They'll come in and check. If the other side's not there, they cancel back the order and they go on their way. When the retail brokers send the order to a wholesaler, they get guaranteed execution in very quick, short order, and they get guaranteed price improvement relative to the NBBO. Now, I'm not saying it's all perfect, by the way. But we have built a retail program to try and entice retail brokers to come here. And there's two sides to every trade. There's the maker and the taker. The maker just means they put their trade out there willing to trade, and the taker comes and takes it. And in our program, the takers are the retail brokers, are the wholesalers representing them.
Yep.
Anybody can come to Iex. If you're a retail broker, you can come, and we allow them, if they do, to trade for free against institutional order flow, which is considered non-toxic, right? It's a slow burn. We launched it in October. We're doing more and more shares per day. We're probably doing 3 to 4 million shares a day on this program. And this just allows institutional clients to trade against retail clients. And we give the retail clients that trade for free, and it's always at the midpoint. So when I was saying price improvement, the market is 10 by 12, the midpoint is 11. 11 is perfect price improvement. You're right in the middle. You're not getting a fraction of a penny in that example. You're getting a penny. So for a retail broker to trade on Iex, they would have to become a member of Iex. Our membership is free. We don't prohibit anybody, as long as they're a registered broker dealer, from joining Iex. So sometimes, to your point, you'll see that retail brokers will, for lack of a better term, rely on their wholesaler partners to send the orders to Iex.
Okay.
But usually when a wholesaler comes to Iex, while the order is on behalf of a retail broker, if they come in, they have to attest it's coming from a retail broker. It's not directed by the retail broker to go to Iex. The wholesaler in their business model will go, oh, there's a midpoint fill there. That's good for me. It's free for me. It's good for the retail investor. It's good for my average price improvement. And that's what we're trying to do. So it's like, it's not lead a horse to water, but if you can provide meaningful price improvement, you can provide the data, which we started making the data publicly available the last 2 months. It's going to become a harder and harder argument. The more people we have providing liquidity to interact with retail, which it's our job to do, and frankly, other exchanges' job to do. We all need to get our head out of our asses and stop going, the system's not fair. We just need to figure out a way to entice, sounds like a negative word like dark pool, but I'll use it, entice retail brokers to come directly, and the wholesale brokers, on behalf of retail, to come on exchange. And it's a long slog, but we are seeing people do it finally.
Yeah, that makes sense. You kind of answered my next question, where we've seen evidence of like someone wants to direct their trade to Iex, and then they see that it's been executed through a wholesaler.
Yep.
And it's kind of left a bit of confusion for retail going, what's going on here? It went to a wholesaler, and then it was executed on Iex. So that makes
sense. The answer is this: is the retail broker that they went to is not a member of Iex. And I'm not throwing mud here. That's their choice. It's free to be. We don't charge you for the trades, but there's some complexity involved in running your own router. And if they can have a wholesaler do it instead, they will. So yeah, you probably have people in your community who said, hey, I sent an order to Iex, but it was sent to Iex through Citadel, for example. That's because the retail broker that they asked to send to Iex is not a member here.
How is that different from payment for order flow?
It's the same thing as payment for order flow, because when the retail broker sends the order to the wholesaler pays them for that order flow. Whether they trade it on Iex or they trade it internally, payment for order flow is on a per share basis. So that comes down to an arrangement between each retail broker and the wholesaler. But essentially it's this: the retail broker takes the order, sends it to the wholesaler executes the order, let's say the 79 shares, and pays them per share payment for order flow. And of course it's understandable why people would question, like, there's no free lunch in this world. Why are they paying to interact with your orders? I'm not saying every order is being fleeced. There's many things in the market, and like, you have to understand, people are not out there to lose money on every trade for the good of a retail investor. And that might not be the most popular thing to say, but to me, I mean, my alternative would be maybe pay $15 a trade or something, or pay a per share trade. So you're not paying the same to trade 1,000 shares as you pay to trade 10 shares. There's a way to do this. Like institutional brokers, they charge the institutional buy side on a per share basis. And if you're charging someone less per share than it costs you to execute it, you're a very bad business person, one, and you should change your pricing. And there's a way to do that. But like, to trade on exchange, just so people know out there, a lot of times when you see there's 10,000 shares available on NASDAQ as an example, and you want to buy it, that's called taking the liquidity. Your broker who goes and does that will pay 30 mils, a third of a penny, in order to execute that per share. It costs them money to trade that for you. So if you're not paying a retail broker and a retail broker is sending it to a wholesaler, the wholesaler's paying the retail broker. Sure as shit, the wholesaler's not going to also pay an exchange 30 mils. How in the name of God could they even keep the doors open or the lights on? So that's why things like that need transparency. And I think actually, if I talk to like your community and I said, look, how about this? You pay a half a penny per share you trade, half a penny, and you would get better execution. Would you do it? If you choose, like there's a retail broker, Interactive Brokers in the US. They have their regular platform where they send it in, you pay them to trade it, or they have their wholesaler platform where it's free to trade there. This is not Ronan from Iex saying it. They will tell you the execution quality is worse over there. But like by the same token, you could say, you know, my father-in-law, if you bought 10 shares of Apple, do you really give a shit that you could have bought it for a half a penny per share less? Do you really care because you can hold it for a year? And I think that becomes, you know, dealer's choice, right? If you're coming in and out, like a lot of your constituents, Superstonk, are very sophisticated retail, right? They're not buying one share of Netflix and holding it for 2 years. Maybe some are, but like many are like reading charts and getting in and out of stock, and you know they want to trade with the least amount of impact. If you want to trade with the least amount of impact, you can't have your free lunch, right? So I would say, which probably be surprised to say, I think the free retail model with the wholesalers, people are getting a good service. Could it be better? Of course it could be better, but you're not paying. And you can't possibly expect people to trade every one of your shares at a loss to them. Like,
yeah. I think that makes a lot more sense. It kind of uncovers a lot of reasons that we didn't know why these types of business models exist. And how it benefits us, I guess, indirectly, but also doesn't in some ways, one way or another. But there's quite a few questions revolving around how Iex's business model actually works. Could you run us through how you generate revenue and how your model, I guess you already touched on it, but how it differs from NYSE and NASDAQ?
Yep, absolutely. So what we do is, like I've been saying, there's two sides to every trade. We charge for non-displayed dark trading. We just charge both sides of the trade. We charge 9 mils, so a little less than a tenth of a penny per share. And then for displayed trading, we charge 6 mils. So, you know, I guess a third less than non-displayed. Our revenue model is this. Every share traded here, we charge someone. We're not rebating someone. We're not giving anybody. Everybody pays. You could trade 100 million shares here a day or 1 share a year as a member, and you pay the same rate. So what we didn't want to do is disadvantage the smaller brokers, give everybody the same economies of scale, if you will, when they come into a platform. But we trade like today. Should probably look at my system. I'm looking at the door here. We're going to trade over 700 million shares today, double counted. It's not as basic as this, but let's pretend all of that was dark and a tenth of a penny. That's like $700,000. Now, it costs a lot to run these type of platforms. And I tell you all this because this is all public. We don't hide any of this. Our pricing model's there, our volume's there on our website. Brokers have known since day one how Iex makes its money. And, you know, we've been blessed by the support of the institutional buy side and the broker partners. So it's been great. We only make money that way. Now, you might see we had filed recently to charge for our market data. We have always said, you can find any quote where we said it's okay for exchanges to charge for technology. It's okay. That's the way the world works. But you cannot take advantage of your regulatory oligopoly status. I like to call it a regulated oligopoly, and charge whatever the hell it is that you want, because you have to buy their feeds. If you are a member broker of these exchanges, you have to buy them, and they price gouge. So what Iex did is we filed to charge for market data. And people go, oh, you're charging for market data? We are fractions of them. But what we did is in our filing, we outlined all our costs. It's never been done before. Right down to percentage of a person's salary who works on the network switch, down to the cost of the network switch. and we said, these are our costs, 2.4 million a year to run the market data. We will charge everybody enough to make a 25% margin on that. And that's what we're in the process of doing with the SEC. And I only caveat that in case someone like tweets in or Reddit's in, I'm not very good on social media, sorry for the terminology, and says, but they're now charging for market data. And he said they only make their money from trading. We only make our money from trading. Why that's important, though, is if you think about it, the institutional clients pay their brokers on a per share basis, right? They might pay them a penny a share, then the broker pays us a tenth of that penny to trade it. Because volume is variable. So if you go to another exchange, you pay a membership fee, you pay them for all their technology. At the beginning of the month, you are in the fucking hole. And if clients don't come and trade enough with you to offset that hole that was dug day one of the month, you lose with trading on that exchange. You cannot lose from trading on Iex. The only way you can lose, monetarily I'm saying, the only way you can lose is if we charge you 9 mils and you only charge your client 5 mils. Well, then you're like I said, you're a bad business person. But 9 mils is very cheap and competitive for per share basis, and we don't charge membership or anything else. So our model is really, really simple. I joke because if you look at and I say it because I've never done a tweet in my life, but from what I understand, a tweet is like 140 characters. You can fit Iex's entire pricing model in one tweet. When you look at the other exchanges in the US, there's tens of pages of PDFs to figure out, you do this and you do this, but you mix this with that, you pay this on this, and if it's Easter Sunday, you pay that. And it's like, it's mind-boggling. But we're trying to like set a standard for what trading venues should be.
Yeah, that's great. So moving over to something, I guess, more future orientated to kind of wrap this up. Could you tell us a bit about the Path project, which Iex is partnered with?
Yeah. No, so it's funny. They pronounce it Pith officially, I think, but no, because we were calling it Pythir, and the guy who runs the foundation goes, "It's Pith." I'm like, okay, looks like Pyth to me, to be honest, like Python, right? Anyway, exactly. If you think about this, obviously, crypto, blockchain, DeFi, it's a really like hot topic, right?
Yeah.
If you read into it, though, and a lot of your followers and the community will probably recognize, a lot of these technologies are always having outages. It's almost like, and I mean this non-critical. It's this DeFi and crypto is not going away, nor should it necessarily. Like I think it's actually a good idea. But what it needs to do is, if it's going to be adopted by the institutional community for real, you want pension funds to have mandates to trade in these things, you need to do it in a scalable, fast, regulated is maybe the wrong word, but enterprise level grade technology, right? And we feel strongly about that. And Pith was set up to do that. Pith is what's called a data oracle, which just provides prices on a blockchain, the Solana blockchain, so that people can trade smart contracts based on those prices. And the prices that they were getting before on some of these blockchains are like from basically Yahoo Finance and Google Finance, 15 minutes delayed. I'm not even making this up. It's crap. So you had a lot of these market makers, the high frequency trading community, and some other exchanges. We have data. Right now, I can tell you the bid offer. I can't because it's 4:40 in the market close. But like normally during the day, I could tell you in a symbol what the bid and the offer is that Iex sees. It's public, but it's our data. So what we do is we take that data, and in an institutional grade fashion, we report that to the Pith network. And people can trade smart contracts off the back of our quotes. And what's great about it is, it might be like Tesla as one of the symbols, for example. They started with 9 symbols. So we quote Tesla. MyX is another exchange. MEMX is another exchange. All the new guys are in it. We all put in quotes. A lot of the high frequency firms will put in last sale. They'll say, if I traded this 1 microsecond ago, I'm very confident that the price is X. If I traded it 10 minutes ago, my confidence level that the price is X is less. So part of the Pith network is when you submit your price quotes, you also submit a confidence level, like how confident are you on the accuracy of that price at that time? And what Pitt does is takes in all these quotes, the confidence levels, and it derives the fair price to trade the smart contract at. And I think that that's the evolution of, like, we're just a contributor, so I'm not claiming we built this or created this. I think it's great. So we have a group here, a fully owned subsidiary of Iex called Iex Cloud.
Mhm.
And Iex Cloud now has its cabinet in the data center, consumes the feed, and it provides Iex's quote. Because we, the stock exchange, we're not providing a quote to a blockchain, but Iex Cloud does. And I think, I'll tell you, culturally, it's been a great thing for us because employees like to play in the next best new technology and to understand blockchain. Everyone says blockchain and crypto and DeFi, and probably 90% of the people who do have no fucking idea what they're saying or what they're referring to. But everybody kind of wants to do it, and getting to able to play has been great. And so I think, it's not like we're the crypto magnets by any stretch of the imagination. But when we look at the landscape, it's very rational to think it's not going away, nor should it, but it's going to come under some form of regulation, and it's going to become more institutionalized. No one can see any more of these news reports of like fraud, this and that. So I get the decentralized idea and spirit of it. That's a great spirit in a perfect world. And it's not a perfect world. You're always going to find people trying to beat things and loopholes. And I think addressing that with like I always say, it's kind of back to my mantra, it's not high frequency, bad, good. It's you fight technological issues with technology. And I think you need to bring better technology to that space so that the spirit behind it can be trusted. And so that's why we're looking at it. And that's why I thought Pitt was a really good first foray for us. And most of the people in it, many of them had no involvement in anything DeFi, crypto, data Oracle prior to that. So I think it's been great. It's kind of bringing institutional focus. After we announced that we were in it, we got tons of inquiries from brokers, from institutional investors. And their thing is this is, yeah, I'm a big mutual fund. I don't have a mandate yet where they're saying of the 1 trillion I manage, 10% of it should be in crypto. But it's very, very, very reasonable to assume in the coming years that is going to happen. There's going to be some mandate, some carve out that it would almost be negligent to your pension holders to not be investing in some of these things. But you have to invest in tried and trusted platforms and technology. So I think decentralization and regulation and coolness are all going to smack into each other, and I think we'll come out with something good.
Interesting to hear. To wrap up this AMA, putting aside all that we've chatted about, what do you want retail traders to know?
Yeah, I think what I said it a little earlier in this chat. I think it's been amazing, like forums like yourself, to be out there. Like we're watching it. The institutional community is watching it, right? The regulators are watching it. It's really, really important. There's strength in numbers. Much the same way when Iex launched here, we needed the strength in numbers of the institutional investors. I always say the originator of the order has to take control of their order and has to get involved if they're going to try and get some answers and some solutions. And what I've seen anyway, and I'm not suggesting retail investors didn't do anything before, so please, I'm going on what I've seen for the past like 18 months. The originator of the order, the retail investor, has been getting involved, and it's going to make things better for yourselves. And one of you, no offense, is irrelevant because you're not managing $1 trillion like a Fidelity is, for example. But you guys as a whole can have a massive contribution to the market and a massive contribution to how trading goes into the next decades, and inclusive of like crypto. So I think to me, it's kind of like, it's funny, while I run an exchange that doesn't have much retail direct on it because of the way in which the construct is set up. Why am I interested in retail? I'm interested in retail because we already have a retail program where we're providing meaningful price improvement, which I'm very proud of, to retail investors. And probably the only reason we are is because retail investors force people's hands to give them the better execution. So I guess what I would say is like keep at it. There is no downside to asking questions. There's no downside to pushing for answers when you feel your questions are dodged. There's just no downside to it. It's actually what capitalism and good spirit is all about. So I've actually been really, really impressed by it, because if you had come to me 24 months ago, I would have said, look, I have nothing negative to say about retail, but we're an institutional platform. Like what it's not that I don't care about someone because I don't know that person, but it's kind of like that. Like I didn't necessarily care because it wasn't part of what we were doing, and it was always outside the realm of being able to touch it. And you guys have been able to bring it to the realm where now people are looking like, how do we make an effort to get this on exchange? How do we find better execution? How do we find midpoint liquidity on exchange? And like I said before, it's the exchange's job to innovate, right? If you look at it this way, we don't charge the retail investor to come here. We still charge the other side of the trade, the institutional investor. You both want to trade with each other because both are not going to like run each other over in a negative way. And so we make half the vig we make, but it's a trade we wouldn't have had before. And so I guess I'm rambling a little bit, but that's kind of where I feel like it's always amazing to me that how groups, when they get together, can force something like this. And it's been an amazing ride. You know, COVID ends and everyone goes back to work. I hope they don't lose the focus of this.
Yeah. Awesome. Well, we'll wrap it up there. And I just want to say thanks for joining. It's been great hearing your insight on the industry. So I really appreciate it.
Cool. No, we appreciate the look. Thanks for the invite.